Good Monday morning from the Asia Pacific. It's almost 10 a.m. in Hong Kong and in Singapore, 11 a.m. if you're watching us out of Tokyo. Welcome to Bloomberg Markets Asia. I'm David Ingles with Yvonne.
Our top stories this morning: Asian stocks swing as traders brace for a flood of economic data this week. Investors watching if the CSI 300 can mark its 10th day of gains. In a surprise move, Ant Group outbid Citadel Securities for Credit Suisse's investment bank venture in China. And China hits back at the U.S. over Washington's latest report on Beijing's WTO compliance, just as the bloc prepares to meet in Abu Dhabi.
Okay, welcome to the show. Monday morning, the price action looking like this across the region equity market. Just keep in mind, we're coming off 5 weeks of gains. So on the benchmark itself, we're still higher for the day. That's down to really some names over in Japan. A lot in Australia, but as you can see, since the Chinese markets opened up, 0.4%. Case in point, bottom of your screens, we've come off highs of the day. In fact, just on that very note here, let's flip the boards, please. Shanghai Comp, CSI 300, 3,000 above that on Friday, a little bit below that bottom of your screens. That's coming up. There we go, 2,997. We've also come off the highs on the ASX 200, which at these levels is still within about 1% of all-time highs. A lot to unpack as far as the value up program is concerned, and which largely based on price action and reaction from analysts has been generally negative or disappointing. More on that in a bit. And S&P futures, as you can see on your screens there, 0.25% to the downside. There we go.
Yep, and there's a bit of, I guess, pause. Because we have a lot going on, right? The Fed speakers that we talked about, I think there's several, a whole list of it. They seem to be chiming, the same tune, which is that we're pricing out the possibility of rate cuts too early. The market certainly has been repriced enough, especially when you take a look at the short end of the curve for Treasury markets. So will we continue to see that? Is one thing. The week ahead is doing this here. Obviously, we have CPI numbers out of the U.S., so it's the PCE gauge, which the Fed prefers. That's the key one. Japan inflation as well. Core CPI could undershoot that 2% target for the first time in a few years. That might muddle the picture for the BOJ as well. RBNZ decision, that may be a hike there. Keep in mind, we got the budget that coming up on Wednesday here in Hong Kong. India GDP numbers as well. And to wrap up the week, we got that China PMI data too, Dave.
Very important going into the weekend where we get the NPC there, of course. Global macro movers for you. So we talked about the equity markets, and certainly when you look at bonds, we're coming off a little bit as far as yields go. We talked about Japan. Yvonne talked about Japan and maybe the inflation print coming through. And it's not so much just the actual month, and as far as PC is concerned, this applies there too. You look at the 3-month, and how it compares to the 3 months before that, the 6 months before that as well, just to get a sense of the trend and really what the Fed still needs to see. And certainly the conversation has been, we got to wait a little bit longer, and certainly wait is a fairly flexible concept at this point in time. Mark Cranfield is with us right now to talk us through the big market themes of today and the week. He's in Singapore for us. Mark, good morning. Top of mind for you, sir, this morning.
Good morning. Yeah, it could be a difficult week for China, actually, after the solid gains we're seeing for a couple of weeks. Because of that MPC, which is due next week, you might get a bit of a news blackout, really. So it might not. I mean, the market needs the continuous momentum of the good news and the reinforcement that there's more support coming, and we might be a bit short of it this week just because they might be reluctant to say anything ahead of that MPC. And as you said, we've got the PMI at the end of the week, which is almost certainly going to show that they're still in contraction. Be something like the 5th successive month of being below 50 on the PMI. So the data's not going to help China very much. There might not be any particular added news flow to get the market going as well. So, and you've got month end coming as well. So it could be a tricky week for pushing ahead with China equities. Maybe next week will be a better week for them. So that will probably be an overhang a bit. But then, of course, on the flip side, you've got Japan, which only seems to know one way to go. It's just like the Japan story seems to have a life of its own now. Everybody wants to be involved with that.
And Mark, we heard from Jonathan Garner from Morgan Stanley about this, right? And why there's still reasons to be bearish on the Chinese equity market, because return on equity has been declining for the past decade. Opposite story when you take a look at markets like India, markets like Japan. We reached that record last week when it comes to Japanese equities. What's next? That CPI print, is that going to be a likely big catalyst?
People may use it as a reason for thinking that the Bank of Japan is going to push back further and they won't be able to to end negative rates so soon. That might be jumping the gun a little bit, but markets will jump. If you're bullish anyway, people, of course, will jump on any additional piece of information that adds to the narrative in that direction. The bottom line probably is that the Bank of Japan probably wants to end negative rates, but doesn't want to do an aggressive tightening policy. So one CPI data is not going to really change their mind on that, and you're likely to hear BOJ voices going that way. Don't forget, we've got dollar yen still above 150. So we're still in the area where verbal intervention is possible, maybe even forceful intervention if the yen weakens a little bit too quickly here as well. So the Bank of Japan is also aware they have a bit of a role to play. They don't like to talk about it, but they certainly have a role. The quicker they get on with some kind of tightening, it probably will help the yen stabilize as well. So you've got all of that into the mix as well. This CPI data probably is not a huge market mover, but what's more significant for the Japanese equity story is this move towards, the governance story is very good. And then you get these really positive things like we've got Taiwan Semiconductor. Looks as though it's going to open its first big plant in Japan way ahead of schedule, quicker than the one being built in the United States. That's a huge positive for people, foreigners looking at Japan, what they can do and where they're going. That's a huge positive.
Yeah, and to your point, Mark, the earnings story in Japan, this market, even at 39,300, is actually cheaper than it was a few weeks back, just given, I guess, the earnings outlook there. Mark, just one last thing, since we're talking about inflation. PCE, that's on Friday. That sort of tops the list of just a lot of data coming out of the U.S. Don't get me started on a number of Fed speakers this week, but what's the risk to markets this week now?
Yeah, it really is. It's all now about the potential for a rate cut in May. I think we can forget about March. I think most of the market has given up on the idea there's going to be any rate cut in March. But there's still 50-50 on whether we go in May or not. If this PCE comes in too high, the Fed speakers continue to push back, we may remove all the pricing for the potential of a May rate cut as well. And as Jerome Powell said when he was on television recently, he didn't see the first cut coming before the middle of the year, which implies June. So it looks like the market may well get on side with what the Fed is seeing by the end of this week, which would, again, mean that Treasury yields need to go a little bit higher, and it probably gives some support for the US dollar.
All right, Mark. Thank you, Mark Granfield there, our MLI strategist on what to expect this week. Still ahead of Bloomberg Markets, Asia 91, telling us why we all might get China wrong again this year. But I think reasons for upside and positivity, I think this is what the theme is for 2024, according to him. Wilfred Ree joining us at a few minutes' time. I just want to update you on this current situation that's happening in South Korea with this widespread walkout by the country's doctors and trainee doctors in particular. And we're getting some clarity here on just the number of which this widespread walkout has reached. 10,000 trainee doctors have submitted their resignation. Around 9,000 trainee doctors have walked out. So this is what we're hearing here so far. This is when we're seeing a second week of this here with no sign from the government here right now. But they're basically, their concerns is that the country urgently needs to boost the number of physicians. And they're saying creating an additional 2,000 slots for medical schools remains a necessity here today. So that walkout reaching now a second week, Dave.
There we go. And to numbers, as Yvonne is pointing out, too, as well. Also in Korea, which we'll unpack the story a bit later on, the market there is certainly on weaker footing as well, consistent with, underperforming, I should mention that as well, on the back of the unveiling of details of this value program. So it's busy, news-wise, over in South Korea. More on this later on in the show. Now to China, where, in case you missed this junk bond rally on top of the equity market rally has also gained a lot of traction. In fact, on a weekly basis, our gauge here at Bloomberg is now up 11 straight weeks. These are the dollar bonds, offshore, high yield, most of which are issued by property developers. So certainly the floor was in. You could even make that strong argument at this point in time. Wilfred Ree is here to talk us through what's been driving this rally, and perhaps is there another 11 weeks ahead portfolio manager at 91. Wilfred, good morning and hope you had a good weekend. Happy Monday morning. Thanks for your time as always. Just your thoughts on what, I guess backward looking, what was behind the rally and whether or not you think those factors will continue to play a part over the next few weeks.
Hi, good morning. Yeah, indeed, we've seen a very advanced rally in global credit. Even in China, investment-grade credit as well as high yield, as you noticed, has had many weeks of outperformance. And I think in China's case in particular, we are seeing some changes in the data. The data suggests perhaps, I like to say that we could be getting China wrong again this year. And the reason for that is that if you look at the numbers that have been coming out of China, if you look at aggregate financing, for instance, which typically leads property developers and lending, medium to long-term loans, we know, to the corporate sector, but especially to the household sector, has been robust and unusually seasonally adjusted, very strong. You have also the Chinese New Year data suggesting that the Chinese consumer is actually okay, on the whole. And more recently, some of these policy signals, supportive of growth, the LPR cut on actual activity. So you're getting little, I think, changes in the data, which makes us kind of rethink perhaps not to be too pessimistic on the China story. And I think credit spreads are pretty much reflecting that. As you note, the high yield sector, the spreads there are tightening, and that is a composition of still performing non-defaulted credits. And spreads, yes, they have come in quite a lot at about 700 basis points versus US benchmarks, but that's still way above US high yield at about 300, low 300 in basis points in spread. So I think the Chinese credit narrative clearly depends a lot on the macro, and so far we are getting some tailwinds on the macro side.
So you mentioned how tight spreads have been. Do you think that there's room still for those credit spreads to compress further? And how are you positioning around the risk spectrum right now around China credit?
Sure, I think we clearly have to be very selective in high yield space. You can't just buy the index. In the performing names, for instance, the favored space still remains in casinos. Tourism, for instance, to Macau, and even within China shows that the Chinese tourism is alive and well. Gross gaming revenues for the casinos are also better than what they were in 2019. So I think that space seems to be an easy carry place to be in. And we expect some of the issuers perhaps to even buy back bonds. And in the performing names, we are beginning to see headlines, right? I think today it was Power Long that came out to say that at least it's engaging with the creditors with its plan. There are 4 options for creditors. Zhongliang last week also, had a court approval. So we have to distinguish that, the market itself, especially in developer space, has already corrected and has priced in a lot of distress. And going forward, we are seeing some developments, especially on performing property developers. And in that sense, there is still some room, I think, to see high yield spreads do well. But we have to be cognizant, right, that in investment grade space, spreads are really tight. And it's not just in China, it's in Asia, it's also in the US. And you just have to, I think perhaps in this environment, shorten duration a little bit, be very selective. And if it's time to pare back some and wait for some, sell-off due to some unknown, so be it. So I would say take a little bit more of a cautious stance. There's maybe a little bit more to pick, but yeah, perhaps shorten duration and be very, very selective in high yield space.
Okay, you do sound fairly cautious, the tone you just struck there as well. Maybe just a follow-up on investment grade in China. What do you think about Chinese banks?
The Chinese banks clearly still enjoy a lot of support from government ownership. And in that space, they will need to issue in Tier 2 space, particularly for Basel requirements. So I think we will see issuance in the onshore market, and that's going to mean more paper available for people who want to invest in that space. Of course, financing rates are anchored. So the availability of liquidity and funding still remains there for Chinese banks. I think for creditors, for us in the bond market, that remains still a fairly solid narrative. For equity investors, of course, there is concern about NIMS compression, and in that sense, it's maybe a slightly different story for the equity guys. But for fixed income guys, I think so long as we see state continues to be proactive, pro-growth, worrying about the left tails. I think in that space, China banks are fairly sanguine. And even in asset management company space, right, the Huarong is still giving you about 6.5%, 7%. And compared to where it was a few months ago, the very explicit government shareholder support as well there, I think that space continues to re-rate tighter.
Broadly speaking, though, I mean, markets are shifting again when it comes to when the Fed's going to cut, right? It's more about whether it's going to be May versus March now, Wilfred. I'm just wondering, the stronger data that's fueling strength into the dollar here once again. What do you make of this U.S. exceptionalism story? Do you think it has more legs to go? And how big of a risk is that dollar strength for markets?
Yeah, I think it's pretty amazing, right, that we started the year thinking that the Fed does 6 cuts, and right now we're just pricing over 3 by the end of this year. Clearly, the U.S. Labor market, the inflation narrative there suggests that monetary policy hasn't been that constrictive on overall activity. In a sense, it gives us some comfort in Asia if we get some of the export uplift. It looks like the AI demand and the U.S. consumer continues to be fairly robust. So at least that, I think, tailwind helps us on the export side. But clearly, it also means that monetary policy across Asia and especially in China cannot be too loose. So in China's case, I think we've seen, of course, the official monetary policy rates have been pretty stable, since I think it was August last year when we actually had a official LPR / 7-day repo type of adjustments on the PBOC side. But there are, of course, other ways that interest rates in China can adjust lower. So we're seeing that through the bank loan prime rates side of it. And so we're seeing, I think, the official stances of central banks here trying to resist loosening too much, but at the margin, still trying to be supportive of their economies. So it's more of like, we're trying to buy time to get through this period of adjustment.
What if the Fed doesn't cut this year? Is that the pain trade? If it's not, what's the pain trade?
Yeah, I think it's beginning to factor into some conversations, whether it was Bank Indonesia or the RBI in recent weeks, this notion that the Fed cuts will be potentially later, and what does that mean? I think for our markets in particular, we again look at what's happening if in large, domestically driven economies like China, like Japan, they can still run their own independent monetary policy and focus on their own activities. But of course, for the smaller ones, like the Koreas, the Singapores, we are going to have to look at what the Fed is doing. And of course, that means that a later Fed cut is going to delay any rate cuts in most of Southeast Asia.
Wilfred, great to have you. Thanks for kickstarting the week with us. Wilfred Wee, portfolio manager at 91, joining us out of Singapore. I just want to give you more on this walkout here when it comes to the South Korean doctors. So we're hearing a little bit more from the vice health minister of the country, saying the government is open to talks with doctors, and they are warning striking doctors of the legal procedure from March. So as we talked about here, we talked about 10,000 trainee doctors have offered their resignation letters here in the midst of this walkout, which is now marking its second week. We'll have plenty more ahead. This is Bloomberg. All right, more on that Bloomberg scoop now. Bloomberg has learned that Jack Ma's Ant Group has outbid Citadel for Credit Suisse's investment bank venture in China. Let's get more now from Chen, who leads our Asia investing team. It's interesting, a surprise move, as we talked about in the previous hour. But what does that tell you about Ant's ambitions now, of course, after this IPO derailed?
True. It's a testing for Ant to see if they're on the regulator's good side. People familiar have told Bloomberg that Ant is bidding for that unit, that JV, investment banking JV of Credit Suisse's in China, and they're offering to pay more than what Citadel Securities offered. It puts UBS, who's now the owner of that unit, in a bit of dilemma because regulators prefer a foreign buyer for the business. The license was introduced as a way to introduce more global players into the market.
How important is that factor, that it needs to be well, at least the person, the body that takes over this license is a foreign player, or did they go with price?
Ultimately, it's up to the regulator, and I think that given the current environment where there is a lot of concern about China's openness towards financial markets, global investors, the economy slowdown, it would be a signaling move as well if Citadel Securities takes over this business. That said, pricing here is another key because that unit was valued by Credit Suisse at 2.3 billion yuan. However, the Citadel Securities bid was only 1.5 to 2 billion yuan, we were told.
And just remind us, what was the bid from Ant?
We don't have those details yet,
Okay.
but they are offering more.
More than Citadel?
More than Citadel Securities.
Okay. Which is
That's right.
quite low anyway, right? That's your point? Right?
Well, Citadel
yeah.
Securities was the only global player going for that.
Okay, well, there you go. I think the foreign buyer discount, maybe. Right? Lulu, thank you so much. Our Asia investing team, of course, actually leads that unit. Okay, some stories we're tracking at this point in time. BYD on the weekend out introducing its most expensive EV supercar on Sunday. Shares are up 2%. As you can see, the U9 costing $233,000 and will be initially only for the Chinese market here. The BYD says the supercar can hit 100 kilometers per hour in about 2 seconds here and reach a top speed of 309. Also by that metric, the vehicle aims to rival gas-guzzling options offered by Ferrari and also Lamborghini. Now, the Japanese government will give an additional $4.8 billion in subsidies for TSMC to expand its plant in the country. TSMC plans to start shipping chips from its facility in Kumamoto by the end of this year. The new aid will go toward construction of a new fabrication building next to the existing one. The economy minister, Ken Saito, says that TSMC is the most important partner for Japan in realizing digital transformation.
This adjustment will, I believe, improve the resiliency of chip supply for Japan and for the world.
Right. Also on the weekend, you might have read about it, Berkshire Hathaway says its cash pile jumped to a record 167 billion, that's US dollars, in the fourth quarter, in case you're wondering what the metric was there. The firm struggles to find meaningful deals. Chairman and CEO Warren Buffett warned an eye-popping performance was unlikely as the conglomerate tries to find deals at attractive valuations. The firm's fourth quarter earnings came in at $8.4 billion versus $6.6 billion for the same period a year before. Right, plenty more ahead. This is Bloomberg. Oh, I was told we have a minute left. Gotcha.
All right, we're looking at financial stocks here right now in South Korea. Of course, this value up proposition that was brought up here when it comes to the government and how to really kind of replicate some of the success that you're seeing in terms of corporate governance, the like when it comes to Japan as well. A bit of a disappointment there from the street there. So you're seeing some of these financial stocks lower. Auto stocks very much in focus here today. We have Li Auto earnings, BYD. We talked about that new supercar. Also, the chairman proposing to double its A-share buyback to 400 million RMB. The stock up for BYD close to 2%. Toyota also up by 2%. This is Bloomberg.
Okay, it's, there we go. We're going into the lunch break in Tokyo. Live shot there, which still should be a bit chilly, I would imagine. Certainly the opposite is true when you look at this market, and 40,000 is now actually in place. So we've got 200 points up today and a little more of that. We could actually be there by the end of the quarter, if not next week, if not this week here. Dollar yen is still trading, albeit we're lower today. We're still trading at about, that should be 1 month highs there on dollar yen. Some key numbers coming through this week in the form of Japanese inflation. And, of course, that takes us into the BOJ in a couple of weeks. And might they, would they, should they move in interest rates? taking them up from negative, of course.
I mean, the bar is setting to be a bit higher,
Yeah.
right, for them to actually exit negative rates. You take a look at what the inflation prints have showing. I mean, they are in a technical recession as well. So certainly that's why you're seeing the dollar yen still at 150 here right now. You take a look at your Asia dashboard and what we're looking at in terms of markets here today. It's slow going. You take a look at how all the event risks that we're talking about, everything from Fed speakers, you have China PMIs, earnings. Certainly that's one to watch here as well. But yeah, and also China, right? Whether we actually do see a 10th straight day of gains for onshore markets, is that a sign of maybe some sort of meaningful turnaround now? Or is it still something about a tactical opportunity, right? It's still just a trader's market in some ways.
Yeah, and ahead of the NPC, certainly one part of the narrative this week is we might go into somewhat of a blackout period. Some of the policies that were meant to put in place to stabilize this market are out. 0.7% there, as you can see on the CSI 300. So may or may not get day 10. Now, on the Chinese market, we've been talking to a lot of our guests this morning on their outlook for Chinese markets. Have a look.
The broader market itself finally got some footing as the Chinese government continues to stimulate. I was just looking at liquidity injection by the PBOC that continues to start ramping up again, right? So there's support for the market. Obviously, that emphasis on the short sale ban at the open and the close. That's of course that's some pressure on the upward pressure on the market too. And I noted that the short interest in ETFs traded here in the US, so say KWAP or the FXI ETF, that short interest is at the record high. So there's definitely fuel here for the Chinese market to see some recovery.
I do think the index has more to go up. Both the CSI 300 and MSCI China is just below our bearish target. The next thing people will watch, one, earnings, and then two, the twin sessions coming in the first week of March, any sort of policy signs that people can take away from. I do think in the past 2 quarters, you saw the free cash flow for A-share-listed non-financial companies growing much faster than the CapEx.
It's just a sort of a negative fundamental. So there is a reason why this bear market has been going on in China for so long. And until that's addressed, which we think requires consumer to come to the fore, basically through fiscal stimulus that targets the consumer, it's unlikely that the earnings profile for China will turn around.
Okay, maybe markets listening to Mr. Garner at this point in time. You look at the benchmarks, we're down 0.7% on the Hang Seng Tech Index. CSI is down by a similar margin. Now, amidst, I guess, I wouldn't say lack of traction, there has been some momentum in this market. Certainly the defensive plays, high dividend income plays have been certainly outperforming and keep giving. In fact, the MSCI China Banks Index, have a look at this over the past month or so, while that rally has taken place, has still outperformed the broader benchmark.
Yeah, let's bring in Mei Yan, head of Greater China Financials Investment Bank Research at UBS, the perfect guest to talk a little bit about this, right? This momentum that we're seeing in the broader market and also in the lenders, can that continue?
We are positive on the China banks for a couple of reasons. First, we do see the national government, so-called national team, is buying into the ETF, and also previously they bought China banks as well. So the ETF within that, China banks has a big weighting. So 14% or so. So that indirectly supported the bank stocks too. And then secondly, I think high dividend yield is what making the bank stock attractive. So in the H-share banks, it's about 8 to 9%, and in the A-share, it's about 5 to 6%. In our marketing with the China onshore mutual fund clients, they're saying they would be willing to take as low as 4% dividend yield for the A-share banks. Wow. So the A-share banks year to date have rallied about more than 10%, so 11% or so. So from this technical perspective, we're positive. Although on the fundamentals, we're also not so positive.
Why not?
Because we're forecasting net interest margin to compress on the Chinese bank by about 15 to 20 basis points this year. And also we're expecting revenue decline by up to 5% for the major banks, and also pre-provision profit to decline. So what really helps the banks to report a positive net profit growth is the cutting in the credit cost. So lowering of the credit costs. So they will try to maintain flat to positive net profit growth through that.
I think some analysts have said basically that makes this whole downtrend in deposit rates may almost irreversible because the need to preserve those margins. Do you agree with that view?
Yeah, I do agree. I think we've seen last week some of the smaller regional banks, etc., follow the big banks to cut their deposit rate. Our house view is we're expecting about maybe 10 to 20 basis point LPR cut, MLF rate cut this year. But potentially, I think the regulator, the central bank, may cut deposit rate as well to give some room to the banks to maintain their net interest margin, because that's very critical for banks' revenue and profitability.
Okay. Well, as far as lending activity is concerned, and we're coming off, I think January is always a good month anyway for credit expansion and credit lending in China.
Yeah.
Where do you see the most expansion at this point in time? In other words, what parts of the economy are getting the bits of credit that they need?
Yeah, January TSF, total social financing and loan growth was like record high. However, though, we do see most of the credits flow into, let's say, corporate side, particularly mid to long-term corporate, which meaning the infrastructures, the SOE, large state-owned companies. So the underlying true sort of corporate capex need demand, and also the consumer side, we're seeing very little improvement. Within the retail side, there's some growth in so-called operating loans. So small business operating loans, inclusive finance loans, that's encouraged by the government. So the big banks are doing quite a lot of that, but at much lower rate than before. So that's also hurting their net interest margin.
You just came back from a trip to Beijing. I'm just wondering, in terms of the feedback that you got from there, how are people still looking at this sector right now? You mentioned that even 4% dividend yield is still okay among some investors. What about some of these kind of long-term investors?
Right. A lot of the large funds, like the mutual funds, etc., we met with, I think they are positioning in the China banks because they're sort of hiding there. And they, wanted to have these high dividend
It's defensive
stocks.
play.
It's defensive, yeah. But we're also seeing at the same time the regional banks are doing better even than the large banks so far, because we are expecting them to report net profit or revenue positive growth. So that says some regions may do better than the other regions. So I think the A-share investors onshore are being more selective. And I think the regional banks this year will have a better performance than the large state-owned banks. If you're talking about offshore marketing, we also meet with investors outside China as well all the time. I think people are still bearish fundamentally about long-term bearish on China and also on the Chinese banks. So that's why the H-share banks' dividend are much higher than the A-share. So they don't have to, offshore, they don't have to be in China. If they're bearish, they just leave. So there's no such a flight to safety in the H-share.
It's almost double, right? I think it's, 8 to 9%, 5 to 6%?
5, 6. It's like a 50% higher.
50% higher.
Yes.
I guess my next question there would be, does the overall market need to remain a bear market for banks to thrive and do well?
That has been the case in the last 3 to 4 years. In the bear market, the bank seems to be counter-cyclical or the negative beta, especially the large SOE banks. So it depends. I think at this point, general view is still China market may be bearish, so they tend to outperform. If we have 3 subsegments within the China banks. The SOE banks are positioned as defensive, and then the joint stock banks, like quite a lot of them focusing on retail, on the capital market, etc. They may outperform if the market truly turns to be more positive. And then the regional bank is also more, I guess, sort of a bit in between. So I think if we watch the cycle to be truly turned around, I think the joint stock banks would be the ones that to play.
How concerned are you about the mortgage side of the business? We had DBS on last week just saying that if we see property prices fall some 20% in terms of ASP, there is a risk of underwater mortgages now. Is that something that you're looking at?
Our estimate for the overall LTV loan-to-value ratio for mortgage is probably around 50%. So theoretically, you need a very big drop for a price, from the peak to drop by about 50% for the market to be for the mortgage to be a negative equity. So far, probably the property price has gone down by maybe 20 to 30%, depending on the location, etc. So I think the mortgage is still positive equity. But the pricing, the volume are all impacting, I think, the negative side coming in from the developers' loan default, which is the biggest loss for the banks potentially.
Is that a big part of the book, of the loan book, or
it's
negligible?
It's about 6% or so. Okay. Mortgage is more than 25%.
Okay.
Yeah.
Okay. So, well, that's a trade-off, though, right? Which one does well?
Yeah.
Mei, thank you so much. Mei Yan, out of UBS, they're head of Greater China Financials. The investment bank research there, of course, at the bank. We didn't get to earnings. Certainly earnings are coming up for Chinese banks. Earnings are also coming up for other Chinese companies. Baidu, NetEase are due out, as you can see. So this is her calendar for the week across the Asia Pacific. Speaking of banks, you have OCBC coming out on Monday. That's, of course, in Singapore. And, of course, the operator of the exchange here is also coming out. Plus, I guess in time for Thursday, Budweiser. Anyway.
But more fodder for the whole AI trade, right? If you hear anything from Baidu in particular as well. Coming up, the rally that pushed the Nikkei past a record high looks set for further advances as foreigners rush back in. We have more on that story coming up. This is Bloomberg.
I guess we're there. Tells you what lies ahead if you wait 35 years, right? Patience is a virtue, but certainly I think one of the things that this reminds me of is don't lose hope. I guess in many ways, and certainly on total return, this has broken even long before last week. But then again, I mean, it's also about timing this market. And certainly if somebody told you 3 years ago that Japan would be up 3 times, we call you crazy too, right? So in other words, we don't really know where the market goes, despite us trying to figure out on a daily basis.
We just ask the questions.
Yes,
Let's get to Winnie
and they do the wrong answers.
Our Asia equities reporter joining us now. Winnie, we talked about that chart, right? That 1989 high that's been reached last week. Where do things go from here?
Right, definitely was a really big milestone for us, but it's definitely also not the end of the story. So we're actually seeing, more foreign investors coming into the market to join this rally, especially when they're also quite fear of losing out this big party, I would say. We saw foreign investors buying Japanese stocks for 7 weeks straight already, and given that they are still pretty much underweighting Japanese equities among their global portfolio, there seems to be more room to grow. And when you compare that foreign investment buying during the Abenomics, which is about 15 trillion yen. We're probably not even half of that level since the beginning of the rally, which was like early 2023. And also other drivers are still pretty strong outside of just flows. When you look at some of the macro environment, we've got Japan potentially already heading out of deflation and heading into inflation. You've got a pretty strong U.S. market, and also Chinese market is still pretty weak in terms of the economy and also struggling with some of the property issues. So that would also help Japanese equities to stay relatively attractive. And from the fundamentals perspective, we've seen pretty strong earnings growth and also the Tokyo Stock Exchange's corporate governance reform to encourage more buybacks. That's also something that investors continue to look forward to.
In fact, South Korea, which we'll talk about in a moment, is taking a page out of Japan as far as this corporate governance is concerned there in the Value Up program. But let's talk about Japan still. So fine, there's some momentum here, but you could look at it the other way too, Winnie. Are there signs of overheating at this point?
Right. So people say that after such a big run, there is some potential of a correction, but it just probably would be some price consolidation and is not really a big concern. But a couple other risks I think is worth flagging. We see that the Nikkei, yes, hit a record high, but the Topix is still about 7 to 8% away from its record high, which also means that the rally so far has been pretty narrow, focusing on some of the big caps like the Tokyo Electron or fast retailing Toyota are really driving the index up. So it would be nice if we can see how the rally could potentially broaden and to see all Japanese companies really, really riding this rally together. And also you've got some of the because the flow is mainly driven by the foreign investors so far, it would be also nice if we can see domestic investors feeling more confident about Japanese equities as well. And I would say one of the bigger risks that people are saying is about the yen appreciation. So with the Fed potentially going to cut rates maybe in the summer, and also the Bank of Japan to tweak the monetary policy, the yen is likely to strengthen, which would weigh on Japanese equities. And now we're hearing some of the investors, especially global investors, recommending that it's a good time to start unhedging the Japanese currency when it comes to investing in Japanese stocks.
Winnie, great stuff. Winnie Su there in Tokyo for us on largely the bull case there on Japanese equity markets. Now, South Korea is actually looking to take, as we were just pointing out there, to take a cue from its neighbor Japan. They're just today, in fact, a few hours back, unveiling the details of this corporate reform plan. They're calling it Value Up, the Value Up program that aims to push Korean firms to improve things like governance and management. But markets don't seem to be very impressed, at least, with the initial reaction today. Yukyung Lee, our Asia Stocks reporter, is in Seoul for us to talk us through the key points of this program. Yukyung, yeah, so what do we know about about the program right now?
Sure. So, yeah, I can feel South Korean authorities and Korean stock market investors feeling envious about this rally going on in Japan, whereas Kospi today is falling more than 1% after South Korean authorities unveiled more details about this corporate value up program. So not much investors, not much of the details that would force companies to come up with voluntary measures to improve their corporate value, investors say. One of the incentives they unveiled today is about tax benefits, but the South Korean government has fallen short of unveiling what kind of specific tax benefit it would offer, saying that those guidelines and details will be finalized during May. So that was a disappointment to investors looking forward to today's announcement for final details of this program. Another measure that they say will come up with is that later this year they will come up with Korean Premium Index that's very similar to Japan's JPX Premium 150 Index, composing of best practicing companies in trying to enhance their corporate value. But they also didn't say what kind of criteria they will look into for the companies to be included in these measures. What they said was that the index will be used as a benchmark for the pension fund and other institutional investors. But what I heard from the market so far is that they still lack what kind of details will be included in this Korea Premium Index. So lots of details still to watch. So that's why we're seeing some of the disappointment and the sell-offs in the markets, especially among the stocks that have driven gains ahead of the announcement on expectation for the better corporate value and improved shareholder returns.
Okay, so yeah, we have some quotes of what people are saying, right? I think Samsung Asset Management is saying, look, there was a lot of kind of pent up sort of speculative money buying last week ahead of this announcement, and then I think, as you mentioned, there was not really quite meeting expectations there. So tell us more about the disappointment. I mean, what did fund managers really want to hear from the FSC?
Yeah, sure. That's a really good question. So one of the key things that investors told me they were looking for was some measures related to treasury share cancellation. In South Korea, a lot of companies, especially chaebol, often use treasury shares in order to protect the controlling shareholders that are founding families of these chaebol conglomerates, where instead of canceling them for the benefits of the broader investors, so that measure was missing in today's announcement.
All right, thank you, Yokyung Lee, there, Asia stocks reporter joining us out of Seoul. We got plenty more ahead. This is Bloomberg. Well, a decades-old global consensus that's allowed e-commerce to grow without customs charges will be in the spotlight as the WTO gathers in Abu Dhabi this week. Bloomberg's Tom McKenzie looks at what's at stake.
Streaming a Netflix movie in South Africa, an international Zoom call with a doctor in India, downloading an e-book on a beach in Bali. They're just a few of the online transactions that could face new taxes. That's if a 26-year-old e-commerce deal falls apart. The agreement blocks tariffs on digital transactions, wherever they occur in the world. It obviously benefits major US tech companies like Amazon, Meta and Netflix, but it's also good news for smaller firms that collect data and do business in international markets. And it's big money. The US exported more than $600 billion of digital services in 2022 alone, with the UK at over $300 billion. When the World Trade Organization meets this week, it'll have a lot on its agenda. But perhaps the most pressing is renewing this deal, which expires on March 31st. They've re-upped it every 2 years since 1998, and some countries want to make it permanent. But experts think Indonesia, India and South Africa could oppose it entirely, and it would only take one to scupper the deal. The tariff revenues that governments could generate without the truce might not be massive, but the move would be hugely symbolic and could represent a big win for the global south. It may also be the biggest protectionist threat the internet has ever faced.
There we go. T-Mac in the house. Tom McKenzie.
We miss him every day.
Yeah. Not Tracy McGrady, who's the other one. Anyway, there we go. Markets are on offer mostly. We're still higher in the benchmark, though. This is Bloomberg.
It's almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asian stocks swing as traders brace for a flood of economic data this week. Chinese stocks edge lower as investors await signs of more stimulus. In a surprise move, Ant Group outbid Citadel Securities for Credit Suisse's investment bank venture in China. Plus, Disney and Reliance Industries set to sign a binding pact to merge their media operations in India. Well, it seems that traders are sitting on the sidelines as we await that much anticipated data out of the U.S., the PCE, the much preferred gauge of inflation for the Fed. That's coming out, and investors are keeping a very close watch on that. Also, more Fed speak. We are expected to hear more Fed officials saying that, you know what, the Fed is in no hurry to cut rates. Take a look where we are in terms of the CSI 300 index consolidating after 9 days of gains. Well, there's cautious optimism out there saying that perhaps the rally can continue if the right market policies remain in place at NPC meeting front and center. The Nikkei 225 in positive territory, extending the record highs, up by 0.5% right now. There is a sense that some say the rally is just getting started because more foreign investments are set to come in. Bear in mind, the yen remains weak above that 150 level, and that's propping the Nikkei 225, helping exporters in particular. In the FX space, we're seeing weakness pretty much across the board. Weakness for the Kiwi, the dollar, as well as the Philippine peso. Take a look where we are in terms of the bond market at this point in time. Of course, bracing for a barrage of eco data that Fed speak yields across the curve just off their highs year to date. Of course, we're talking about treasuries. The MSCI currently about 0.1% higher. Flip the page. Take a look at what we are setting up in terms of India. Of course, we know that Nifty has had 5 days of gains. It is off session highs. Currently, futures pointing to a lower open. A 0.1%. And as far as the emerging markets index is concerned, it is trading lower as well, in line with the rest of the region, down 0.3%. As we said, a packed schedule for key economic data coming this week. We'll be keeping an eye on the latest GDP and inflation readings out of the U.S. Bloomberg Economics expects headline and core PCE numbers to come in hot for the fourth quarter. Japan also releasing CPI data with core inflation seen to undershoot the BOJ's 2% target for the first time since March 2022. And we'll get fresh PMI readings out of China on Friday, which will probably show activity pulling back due to disruptions from the Lunar New Year holiday. And the RBNZ set to keep rates on hold as it waits for more evidence that inflation is under control. And we've also been hearing from strategists this morning on the outlook for Chinese markets. Take a listen.
The broader market itself finally got some footing as the Chinese government continues to stimulate. I was just looking at liquidity injection by the PBOC that continues to start ramping up again, right? So there's support for the market. Obviously, that emphasis on the short sale ban at the open and the close. That's of course that's some pressure on the upward pressure on the market too. And I noted that the short interest in ETFs traded here in the US, or say KWAP or the FXI ETF, that short interest is at the record high. So there's definitely fuel here for the Chinese market to see some recovery.
I do think the index has more to go up. Both the CSI 300, MSCI China is just below our bearish target. The next thing people will watch, one, earnings, and then two, the twin sessions coming in the first week of March. Any sort of policy signs that people can take away from. I do think in the past 2 quarters, you saw the free cash flow for Asia-listed non-financial companies growing much faster than the CapEx.
It's just a sort of a negative fundamental. So there is a reason why this bear market has been going on in China for so long. And until that's addressed, which we think requires consumer to come to the fore, basically through fiscal stimulus that targets the consumer, it's unlikely that the earnings profile for China will turn around.
So is it time to buy China? Let's get more on markets with Stephanie Holtze-Jen, Apex CIO at Deutsche Bank International Private Bank. Stephanie, good to have you with us. 10% gain in February alone for China ain't too shabby. I mean, it must spark a FOMO trade in some sense.
Yes, so we are now at a point where year to date we have turned in the green for most of the Chinese equities indices. So I think that is definitely arguing for trading opportunity, even if, we had initially looked at it for a second half, kind of sustained opportunity into Chinese equities. But I think right now, we have already seen that 2 things work. Number one, we have seen the government's resolve in terms of, putting in regulatory measures around the equities market to, improve sentiment. We have seen, since the beginning of the year, so many actually government measures coming in. And now the Lunar New Year holiday has sparked a bit of optimism, given we had a lot of activity data that has even been, better than pre-pandemic. And I think these 2 things have been stabilizing the market. And, in terms of a trading opportunity, of course, we need to see whether there is a sustainable rally on the back of it, because right now, for me personally, 3 things need to happen at the same time. So one is the sentiment shift. So we get a little bit of that. You can see how the coverage of some strategists are, looking at it more positively. The narrative changes quickly when the market starts to rally ahead, of course, right? But on top of sentiment, you need the flows coming on the back of it. And then, of course, you need macroeconomic data to also, give you more confidence in the longer-term growth prospects. And I think this year, you've mentioned some of the data. This week may not be the week to get a positive surprise on this, but I can see why the market is kind of consolidating this morning. But overall, I think it's a trading opportunity that at least starts in the short term, and hopefully, we'll see more pronounced in the second half.
So where are the opportunities? If it is time to buy China, what do you buy?
Yes. So we actually feel most comfortable, even in that short-term possible trading opportunity, to go for the sectors that will continue to see demand and support. So demand on the one hand and support from the government policies going forward. So one, to start off is consumer discretionary. Of course, there is the one-off element of the Lunar New Year holidays. They only take place once a year, first time in 4 years that they really could celebrate without any restrictions. But, if this is being continued, that is a green shoot. But in the consumer discretionary sector, there's more to it. We also like subsectors that are, for instance, around, sports apparel, because there has been a shift towards a more healthier lifestyle, for instance. We also like the cars that are part of it. But again, I think the narrative needs to be that there's also government stimulus, and given how important the consumer is for the economy and to also stabilize the property sector sentiment, there will be more government stimulus coming into the sector. Now, I have two more.
Okay, go ahead. Two more, quickly.
Just very quickly, I think IT is another one, and then, of course, the green sector, where a lot of investments are also going into solar, wind, etc.
How about Chinese bonds? They've been rallying on expectations that we'll see more rate cuts for China to fight deflation.
Yes.
Do we continue to buy Chinese bonds?
There will most probably be more monetary stimulus coming from that end. But right now, I think we've already gotten a bit of a glimpse that the government is navigating this very carefully, because on the back of every rate cut, there's also the risk that you have a currency reaction function. And I think we've seen this happening with the repricing of the US dollar on the back of a hotter CPI. And if you then would have added another rate cut in the short term, you would have risked to have renminbi also coming under pressure. So I think there will be a careful steering around this, and I would actually consider more the equity side than the bond side right now.
You talked about the US dollar strength.
Yes.
How are you assessing USD exceptionalism?
US dollar exceptionalism has been there for a few reasons, because of a very aggressive rate hike cycle and because of the safe haven element of the US dollar. Now, this year we'll have one of those elements falling away. For us, this is in the second half, because we see rate cuts kicking in. We only have 3 rate cuts to the tune of 75 basis points for the whole of the year, starting by mid of the year. So at that point, the exceptionalism for the US dollar will stall. But having said that, because most of the central banks will most probably go in tandem, for the US dollar, it will be more of a sideways situation. But of course, this will be also triggered by some short-term volatility, because which central bank is first kind of leads the narrative on interest rate differentials. The US dollar, though, that's that second element that will stay with us this year, is still a safe haven go-to currency when you have a lot of geopolitical risks happening on all these elections that are coming our way this year.
The thing is, what's the risk that USD's exceptionalism might be a real risk for the markets? We're seeing markets right now, a lot of markets are trending at record highs.
Well, a risk for the market in terms of once it stops, the markets fall off the cliff?
Yes.
Yes. I think because I don't see US dollar exceptionalism to go away completely, I don't see the associated risks that you mentioned for it. It's more of a sideways when others maybe project a total turnaround in exceptionalism or a continuation. I think we just kind of stay where we are.
And of course, all eyes on Japan. Traders are looking at the 40,000 level. They say it's coming, and it's coming sooner than you expect. Yes. More money, foreign money, pumping into Japan?
Well, now you mentioned, first you mentioned the US equities market being at highs. You have Japan being at highs. Of course, it begs the question, how much further can you go? I think, but when you look at Japan, you have a very strong story, of course. And I know we are in uncharted territory, but we're also in uncharted territory in terms of the structural reforms that were started last year and that continue this year. We also are in uncharted territory in terms of the cyclical element that is boosting, the returns of Japanese companies because of a very weak yen. And it looks like that this will not go away anytime soon, because that dollar-yen dynamic, which will be gradually edging higher, will continue to be in place. So I think, yes, Japan has more legs to run, but of course, as much as you do not want to be in a broad index, when you, in uncharted territory, you go for the sectors that are the most likely to succeed.
Stephanie, thank you so much for your insights today. Stephanie Holtze-Jen from Deutsche Bank International Private Bank. Well, still ahead this hour, we'll hear from Tata Consultancy Services on how the firm has integrated AI and Gen AI into their business model. We speak exclusively with a CTO shortly. Keep it here with us. This is Bloomberg. Chinese markets consolidating after 9 days of gains. The Hang Seng currently down by 0.7%. China Shanghai Comp up by 0.6%. Ain't too shabby, though, for the month. We have Chinese stocks up about 10%. The question really is where it goes from here. Investors looking for more policy support. That MPC meeting will be front and center, looking for a bold policy to help prop up not just the markets, but also the economy. Now, Bloomberg has learned that Jack Ma's Ant Group has outbid Citadel for Credit Suisse's investment bank venture in China. Let's get more from Lulu-Jen, who leads Bloomberg's Asia investing team. Of course, Lulu, this was a big surprise. What do we know?
Well, as the key here is the pricing and also regulatory approval. Sources told Bloomberg that Ant Group has outbid Citadel Securities for the JV of Credit Suisse in China. They're offering to pay more for that unit, but regulators do prefer having a foreign buyer for the investment banking JV in China because that license was created to introduce more global players. UBS has some hard choices to make here.
So in terms of getting that approval, you said that it's going to be hard because China prefers a foreign player. What are the chances then? And what can Ant do to counter that?
Well, this will be a test to see whether Ant is on the regulatory good side following that fine slap in July last year where regulators said that they have wrapped up all the regulatory clampdowns on China's internet sector. For Ant to outbid Citadel Securities, pricing is on their advantage. But that said, UBS will have a lot to consider, one including whether Founder Securities, which is their JV partner, would be happy with what Citadel Securities is offering. That unit was valued at 2.3 billion yuan by Credit Suisse earlier, but now the offer only stands at 1.5 to 2 billion yuan. And so they need to see whether more players are coming in to see if they can offer more or if there's some more dynamic that they can push between these two current bidders.
Lulu, I'm wondering, might there be other bidders? And if so, who might they be?
Well, it's a very challenging environment right now in China. Foreign investors are really staying on the sidelines, looking at China's economy and also the current concerns of the regulatory clampdowns, the stock market rout, and then even more heavy-handed measures regulating the space is deterring more foreign investors from putting more resources into the market. That's why Citadel Securities is currently the only bidder for the unit.
And back in the headlines, Lulu-Jen, good work as always. Lulu-Jen leads Bloomberg's Asia investing team. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Let's talk crude. And we have oil kicking off the week with a drop. Traders are waiting cues on that market balance where Brent dipping towards 82 a barrel after losing more than 2% last week. And its U.S. counterpart, West Texas Intermediate, above that $76 level. And we have Europe gas futures down about 1%. Now, long-standing warnings from the oil tanker industry that too few ships are being built are coming back to haunt the market. Just 2 new supertankers are due to join the fleet in 2024. Adding to that, widespread diversions after Houthi attacks on commercial shipping in the Red Sea. Our Asia oil trading reporter Elizabeth Lowe is with us. And Liz, the tanker market looking at the lowest number of new deliveries in almost 4 decades this year. Why is that significant?
So I think oil's a little bit softer this week, so there isn't really any immediate panic. But given the context of what we've been going through with the Red Sea, or at least the market's been going through, that could be a pretty bullish factor for oil freight in the coming months. So as we know, shipping has been a pretty large focus for oil since December because of the attacks on merchant vessels by Houthi rebels in the Red Sea, which is forcing a lot of the tankers to reroute to a longer route around Africa. So crude and oil product markets have been pretty affected by the situation. It's a really important route for them, and the rerouting is already tightening the availability of tankers to ship them. So right now we're in the middle, we're just right after Chinese New Year, where I think oil markets tend to reassess. So I think this week will be pretty revealing. So according to S&P global data, vessel utilization rates are already 5% up so far. So I guess the market's just factoring all these, the super low number of tankers coming into the market this year, which could make the situation worse if the Red Sea tensions stretch out.
Liz, the question really is why? Why are there so few tanker deliveries this year?
Well, so these tanker orders are typically made like years in advance before delivery, and so this year's numbers would have been made on based on our assessments of an oil market years ago. So, and if we just look back at 2019, even though freight was pretty good then, there were also many predictions that oil demand would begin to peak soon after COVID. And those estimates have changed drastically since then. So I guess my point is it's been notoriously hard to predict oil markets, and it would have been the same for anyone doing estimates for the oil tanker markets as well, which is why we're at the situation we are today.
Liz, thanks so much for that. Asia Oil Trading reporter Elizabeth Lowe. Now here are some top geopolitics stories we're tracking. Ukrainian President Vladimir Zelensky says the country has lost 31,000 soldiers as its war against Russia grinds into a third year. He also reiterates calls for U.S. funding and says 2024 will determine how the war will end. President Biden and fellow G7 leaders have assured Ukraine of their support in a video conference call. They say they are stepping up security assistance and working with Kyiv to meet its financing needs. Michigan Governor Gretchen Whitmer has warned President Biden risks losing support among the U.S. state's Arab and Muslim population over his support for Israel. Democrats worry Biden's pro-Israel stance will alienate voters in Michigan, which is home to a large Arab American population. A January poll showed Biden trailing Republican frontrunner Donald Trump in the state in a hypothetical 2024 rematch. And Australia is seeking an end to China's wine tariffs, which were imposed after Canberra sought an investigation into the origins of COVID. Australian Trade Minister Don Farrell is expected to discuss the matter with his Chinese counterpart at the upcoming WTO meeting in Abu Dhabi. Bloomberg's Paul Allen explains what's at stake.
It's been a challenging few years for Australian winemakers. When China slapped tariffs of up to 200% on Aussie wines in 2020, it left the industry scrambling to find new markets.
We lost everything overnight. We had built a business in China.
When Australia called for an international investigation into the origins of COVID-19, China responded with a range of trade strikes against Australian products. The relationship has since thawed. Barriers against barley, coal and other exports are now gone, and wine is expected to be next. Australia suspended its appeal at the World Trade Organization over the wine tariffs when China announced a 5-month review. That review ends on March 31st. Australia's Trade Minister will meet his Chinese counterpart on the sidelines of the WTO meeting in Abu Dhabi.
We want the tariffs on Australian wine removed, and if we don't get that, then we'll resume the WTO application ASAP. Our agreement to suspend the WTO process was based on the successful removal of all of the tariffs.
Shares in Australia's largest listed winemaker Treasury Wine Estates have slowly recovered since China imposed the tariffs in November 2020. In this month's earnings announcement, Treasury also signalled it's expecting something to celebrate soon.
The review of tariffs on Australian wine remains ongoing, with a determination anticipated in late March. We are prepared and we're well placed to re-establish ourselves and our Australian portfolio in China should the review result in the removal of these tariffs.
But there's a question about what Australia's exporters have learned from the whole experience when it comes to reliance on China. Take barley, for example. China went from buying almost all of Australia's barley to buying none at all during the diplomatic deep freeze, forcing exporters to diversify and find new markets. Since tariffs were lifted, Australia's barley producers have gone straight back to their most lucrative buyer, with China accounting for 90% of exports in December. And of course, when wine begins to flow, memories can become hazy. Paul Allen, Bloomberg.
And in the markets, we're keeping an eye on AI stocks in China as well as Korea. They're getting a lift after news that Jeff Bezos, Nvidia, and other big technology names are investing in a business that's developing human-like robotics. Take a look where they are trading at this point in time. We have Ningbo currently up by 2%. Miracle Automation Engineering up by a massive 10% as we speak. Of course, this startup is called Figure AI. It's backed by OpenAI and Microsoft. Flip the page. Take a look where we are in terms of some of those Korean financial stocks. South Korea plans a value-up guidelines to ensure expansion of listed companies' voluntary participation in the program while minimizing burden of the companies. That's on the back of the comments made by Finance Minister Choi Sung-mok. Take a look where they are at this point in time. Under a lot of pressure, those financial stocks. Hana Financial down almost 6%. Samsung Life Insurance down about 5.9%. In the broader market, well, trepidation as we await that PCE data and Fed speak. Plenty more ahead. This is Bloomberg. Welcome back. China markets just heading to lunch. It is a negative day after 9 days of gain. Still quite a turnaround, up about 10% in the month of February alone, perhaps igniting that FOMO trade. Some say that perhaps China provides greater value than markets, including India. Taking a look where we are in terms of the CSI 300 index, down 0.7%. The Shenzhen Com, though, in positive territory, up by 0.7%, and the yuan trading at 719.81 versus the USD. It's pretty flat, and of course, it's been well supported by the PBOC. Let's flip the page. Take a look where we are in terms of Japan, which is coming back from lunch. It's been extending gains, hitting yet another record high, set to post its second successive months of 8% gain. Some say the rally is just getting started. More foreign demand is expected. Of course, they're looking for the Nikkei to breach that 40,000 level. Not today. Maybe it will end at that level, maybe in the coming days, but definitely looking for it to breach that 40,000 level. No risk of overheating if you take a look at the trading volumes at this point in time, and that's according to some investors. Take a look where we are in terms of the yen. 150.46 elevated, surpassing that 150 level, prompting perhaps expectations of a verbal intervention. That weak yen has propelled that Nikkei 225 higher. The topics also in positive territory. Now, for a closer look at the chips industry, global technology supply chains are set to shift and diversify in response to geopolitical tensions as well as the pandemic. And that's according to the latest report from Bloomberg Intelligence. Let's bring in Asia technology analyst Charles Shum. Charles, given the projected shift in leading-edge chip maker to the U.S. and Europe, how do you foresee this transition impacting the global competitive landscape?
Hey, good morning, Haslinda. Yes, we have done a very thorough checking on all the project and also planned the capacity expansion by Intel, TSMC, and also Samsung. And then we published a report today, and then the conclusion of that report is that it's very likely by the end of 2030, actually, U.S. and Europe, actually the combined capacity of their leading edge, that's 5 nanometer or smaller, could be actually in the same level as the Taiwan. Right now, actually, Taiwan is actually having about 61% of market share. But by the end of 2030, we're seeing that both regions, these three regions can actually share the whole world's leading edge capacity. U.S., Europe combined capacity can up to 43%, and Taiwan down to 43%. That's one of our conclusions from the report today.
Charles, that's a target. How will they get there? What are the challenges faced by the U.S. and Europe?
All right. Actually, one of the big driver behind this quick capacity expansion in Europe and in the U.S. actually we think is because of the generous government subsidy. Actually, because we all knew that actually U.S. has announced a $39 billion subsidy, and EU actually have a $36 billion. And actually, we believe that for all the new projects, if there's 25% of construction cost that's actually sponsored by the government, actually they can cut back the payback period at least by 1 year. So that's one. But that also means one challenge, because if a government subsidy is not delivered as a schedule, that could be a big problem. And another problem we like to highlight here is that when we are talking about the capacity expansion in these two regions, we are not talking about they are building just 2 or 3 new fabs. We are talking about 10 to 15 new fabs. So if each region, they are actually, for each fab, they need 1,500 engineers to operate. So that means at the end, they need about 30,000 new engineers. So it's really hard to imagine how they can get so many people online if that's the challenge. So we would like to say in the report.
Also, Charles, we know that China has its own chip-making ambitions along with Japan now. How might this play out in the market?
Yes, because facing the hidden the geopolitical tension, also the U.S. sanction, we're seeing that China is actually changing their strategy. They're not focusing on the advanced node anymore. They're actually expanding quickly in we call it the mature node. That's 28 nanometers. Mostly, these node process node is used for the production of the power chips, and also for the those chips in the consumer electronics. So we think that actually by the end of 2032, China can still actually grow their market presence from the currently about 27% to 35% by the end of 2032.
Charles Sham, thank you so much for your insights today. Let's stick with technology. Asia's earnings spotlight shifts to China's internet giants this week. Baidu and NetEase will be reporting the latest results just as China tightens its grip on tech companies. For more, let's bring in our breaking news earnings specialist, Rachel Yeo in Hong Kong. And Rachel, China may be looking into ways to steer its vast tech industry. It faces a stock rut at this point in time. How will Baidu and NetEase earnings fare under these circumstances?
Yes, we are seeing more potential moves from Beijing to steer its tech industry. So that could potentially mean more resources are being diverted to priority sectors like AI and semiconductors amidst continued tensions with the US. So this also comes as Beijing is also trying to restore confidence amidst a major stock rout. But the move could be a double-edged sword because Chinese stocks are still struggling to gain valuation, and investors may be concerned about tightening state control as well. So with Baidu and NetEase reporting earnings under this backdrop, Baidu is expected to see its AI revenue being helped because the company had launched more AI products recently, including a program called ErnieBot last year, which functions like ChatGPT. And in terms of its core businesses and ad revenue, it is also expected to remain strong as well. Over for NetEase, we are expecting to see strong earnings for this quarter, but their growth may be moderated in the next few years depending on regulatory oversight from China's video game sector. So weakening demand in the global video game console may also weigh in on overseas sales for NetEase as well.
Right. Rachel, how about Li Auto? It's also out with numbers. What are we expecting?
Yes, for Li Auto, we may expect to see better sales as the company had done some price cuts earlier to fight off competition for rivals. And in terms of quarterly operating profit, it is expected to remain sequentially stable, even though it did spend more on promotion for increasing competition as well. But in terms of its long-term earnings growth, Li Auto may be threatened by iToll, which is under Huawei in the long run. So we will see how that will go for its earnings in the next coming few years.
We'll see indeed. Our breaking news earnings specialist Rachel Yeo in Hong Kong. Thank you. Up next, we'll be speaking exclusively with the CTO of Tata Consultancy Services on how organizations can effectively adopt AI systems. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia. You're watching India Focus. India starts trading in about 6 minutes from here. Futures pointing to a lower open, but bear in mind, Nifty at record highs. Traders say the overall trend remains positive. They say continue to buy the dip. Well, today pointing to a lower open, Nifty futures down about 0.2%. Now, Disney and Reliance Industries are said to have signed a binding pact to merge their media operations in India. Sources say the details could be announced early this week. Bloomberg South Asia editor Anto Anthony is with us. Anto, what do we know so far?
Yes, so Reliance and Disney has signed a binding agreement to merge their India operations, and an announcement is expected as early as Wednesday once certain procedures are ticked off. So the Indian conglomerate, that is Reliance, will hold at least 61% stake in the merged entity, with the rest going to Disney. But the final figures, the exact breakup, will be known only closer to completion of the merger, because it depends upon how certain assets of Disney are treated in this merger. One of the case in point being the stake that Disney holds in a company called Tata Play, whether Reliance will get that or not. So we will know the exact breakup closer to completion of the merger, and the announcement is being expected by Wednesday.
So how will the transaction impact India's media landscape?
This is a binding agreement, and it will take at least a few months for the transaction to complete. Once that happens, then the merged entity will hold, or will have at least, will control more than 1/3 of the media and entertainment market in India. So obviously a big threat or big challenge to other competitors, like other rivals like Zee, Netflix, or Sony. So we are expecting a lot of consolidation to happen in the segment after this, and a lot of the competition will have to change their strategies to match up to the merged entity.
And before you go, Anto, where does this leave Sony? What is Sony's game plan in the country?
Yeah, that's an interesting question. Sony has about less than 1/10 of the market share in the media TV space in India, and they were in a 2-year-long process to merge with an Indian TV network, one of the India's biggest Indian TV networks, Zee Entertainment Enterprises Limited. That would have given them a market share of about 1/4 in the Indian market. But after 2 years of merger negotiations, finally last month, they sent a termination notice to Zee, saying some of the conditions for the deal are not met. But we have to keep in mind that they have sent a termination notice, but they are yet to pull the merger cooperation agreement from the Indian authorities. So that's a space which we are very closely watching. Now, the second thing is that Sony also has to really bulk up or create more content and change strategy and be nimble to match up to the competition if the Reliance-Disney deal go through. So there are some local media reports today about how Sony might be looking at some video streaming platforms for acquisition. Again, a space which we are very closely watching.
All right, details to come. Bloomberg's Anto Anthony, thank you so much for that update. Now, staying with India, software and AI-based automation looks set to grow through this year and beyond. Many firms are now looking to get more from technology in every aspect of their operations. Harik Vin, CTO of Tata Consultancy Services, would know. He oversees the design and implementation of AI and Gen AI for TCS, as well as its clients. Harik, good to have you with us. Give us a sense of the kind of demand you're seeing, the kind of interest you're seeing.
Good morning, Haslinda. Very nice to be here. We are seeing tremendous demand, actually. If you think about the year 2023, it has been all about actually sort of a year of exuberance, every enterprise trying and experimenting with Gen AI, various kinds of use cases. In fact, we are seeing two types of use cases primarily, what we call as augment use cases, which are basically where Gen AI and AI is used as a means to augment the abilities or augment the contextual awareness of a worker. So, for example, when a call comes into a contact center, making the contact center aware of who is the caller, what are the what kind of products they have bought in the past, have they called before, are they happy customers, and things of that sort. All of that is essentially improving contextual awareness. These are sort of augment use cases. There are also assist use cases, which are basically the ones where the machine is doing part of the work for you, such as generating the first version of a code or generating first version of, let's say, a marketing collateral or a marketing campaign. So those are the cases that are actually dominating in the market. We are going to see a substantial rollout and to production of these use cases in 2024 and beyond.
Right. In terms of TCS, what kind of AI pilots are you conducting right now?
So we have more than 250 pilots that are actually going on in all sorts of industries. Essentially, we span all the verticals that are possible. A small percentage of these are actually starting to go into production as we speak.
And in terms of challenges when it comes to adoption, what are you seeing? What are challenges facing all the clients that you have in adopting Gen AI?
I think that's a great question. I think there are sort of two different types of challenges that I think we see. One challenge is how do you actually scale the implementation in an enterprise-wide situation? Because today, building an effective AI solution is an art form. The pre-trained LLMs, you can think of them as world-wise. What is needed for an enterprise to truly derive value is to go from world-wise models to industry-wise, enterprise-wise, and even activity-wise model. And that's actually a non-trivial exercise that one has to go through. The second big challenge that an enterprise is likely to see is that deploying these kinds of AI-based solutions actually requires changing the roles of people, right? And that is essentially a fairly substantial organizational change management challenge for every enterprise.
Harik, we talk a lot about how AI will boost efficiency, productivity. The big question is really what it means for jobs and what kind of new jobs will be created, how many jobs will be lost. How are you assessing the situation and how are your clients adapting to all of that?
I think, once again, a great question. Actually, as I just said, I think the roles of people are going to change with this adoption of this technology, right? The roles of people are going to shift from doers of work. You can think of them as trainers of machines, essentially reviewers of information that comes back from a machine, and owners of critical thinking and creativity, in a sense, right? So because of that, the jobs are likely to shift from their today's jobs to ones where a lot more critical thinking or design thinking or creativity is involved. So for example, if you think about the domain of software engineering, instead of coding and writing a lot of scripts and doing testing and so on and so forth, the skills are going to have to shift towards deciding what to build, why to build, and actually designing and architecting systems. Essentially, once again, a lot more creativity and critical thinking. So this is going to require a substantial shift in how people are trained, not only on how to use Gen AI, but also soft skills, in a sense, of actually a lot of critical thinking and creativity. And that's going to be a substantial change management.
Are you having difficulty in finding talent?
Not really. I think there is a lot of talent that is available, and we have a fairly substantial program to retrain people. So we have already retrained about 150,000 people on basics of AI, Gen AI, and about 15,000 of them at the sort of an expert level. But we are substantially pushing this envelope to see if we can actually train the entire organization of about 600,000 people with the training, with the skills that are required for this new world.
But are you looking beyond India for that talent? And if so, is there a number that you can share with us?
No, we are actually looking at talent globally. We have presence in all the countries. I mean, we have research and development organization also spread across the entire world. So I don't have a very specific number in mind, but essentially we are looking at talent and recruiting them globally.
The AI services industry is currently targeted to grow to $300 billion in a few years. Harik, I'm just wondering, how much of that market are you targeting?
I think a substantial portion, I would say. See, if you think about the market today, there is sort of two different levels. One level is these large language models and so on and so forth, which are, I would think of them as the fundamental infrastructure for all of these AI applications. These are the pre-trained LLMs. The real opportunity seems to be for every enterprise to look at these higher level industry-wise or enterprise-wise or activity-wise models that have to be built. In some sense, building purposive solutions for specific problems or specific opportunities within a particular industry. And that's a humongous industry. In fact, every knowledge work as we know it will essentially get redefined because of infusion of AI and Gen AI into it. And that's really sort of the opportunity that we are really going after.
Harik, I can only imagine that as CTO at TCS, you do use Gen AI. I'm also wondering what applications you're using, how you're using it. Can you share that with us?
Yeah, personally, I think I find these large language models and these sort of worldwide nature of them to be incredibly useful for me to, as almost like my secondary research partner, right? A genius partner that helps me actually explore and investigate new areas that I'm very interested in. So for example, if I'm trying to understand the future of, let's say, environment or future of water or things of that sort, I actually spend a lot of time just going back and forth with these models to actually help narrow down my own thinking process. What's been very interesting, actually, Haslinda, is that when I've actually done this, what I found is that they're a fantastic source of sort of secondary research, but they require sort of the critical thinking that we can do as people to actually guide that conversation. But if you're able to do so, then in a matter of an hour or two, you can actually arrive at incredibly deep, insightful information. And that's really what I use for, in fact, our own planning for where do we invest and how do we actually do a lot of things.
Harik, thanks for sharing. Harik Vint, CTO of Tata Consultancy Services. India's been trading for about 5 minutes. Let's do a check on where the markets are standing at this point in time. We know that traders are awaiting for clues on the global rate outlook, that CPE report out of the U.S., a key report that the Fed focuses on. Sensex currently down by 0.3%. Nifty index lower by 0.2%. Nifty 50, by the way, at a record high for the after that fifth consecutive session that we saw. Rupee at 82.89. Plenty more ahead. This is Bloomberg. Now, a decades-old global consensus that's allowed e-commerce to grow without customs charges will be in the spotlight as the World Trade Organization gathers in Abu Dhabi this week. Bloomberg's Tom McKenzie looks at what's at stake.
Streaming a Netflix movie in South Africa, an international Zoom call with a doctor in India, downloading an e-book on a beach in Bali. They're just a few of the online transactions that could face new taxes. That's if a 26-year-old e-commerce deal falls apart. The agreement blocks tariffs on digital transactions, wherever they occur in the world. It obviously benefits major US tech companies like Amazon, Meta and Netflix, but it's also good news for smaller firms that collect data and do business in international markets. And it's big money. The US exported more than $600 billion of digital services in 2022 alone, with the UK at over $300 billion. When the World Trade Organization meets this week, it'll have a lot on its agenda. But perhaps the most pressing is renewing this deal, which expires on March 31st. They've re-upped it every 2 years since 1998, and some countries want to make it permanent. But experts think Indonesia, India and South Africa could oppose it entirely, and it would only take one to scupper the deal. The tariff revenues that governments could generate without the truce might not be massive, but the move would be hugely symbolic and could represent a big win for the global south. It may also be the biggest protectionist threat the internet has ever faced.
Bloomberg's Tom McKenzie reporting there in the markets. Let's take a look at where chip makers are performing right now on the back of Japan trying to boost its chip-making ambitions, providing additional $4.8 billion in subsidies for TSMC to expand its plant in Japan. TSMC currently down by 1/10%, but those players in Japan in positive territory. Flip the page, take a look at where we are in terms of those stocks that we're tracking, among them BYD, its chairman proposing double A share buybacks to 400 million yuan, and we have Li Auto earnings in the U.S. today. Those stocks currently up right now. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. This is Bloomberg.